Hello, and welcome to the Bull and Bear Invest channel. Today we bring you a beginner's guide to trading stocks. But first, here's a little about us. The Bull and Bear Invest channel is formed of a small group of individual stock traders who aim to share their experience and research with others so they can avoid making the same mistakes that we've made. Stock trading can be profitable and, if you're not careful, very, very expensive. Although our guides contain correct and valid key information at the time of publication, we cannot guarantee that certain rules, regulations or accountancy figures such as tax references are accurate at the time of viewing. We strongly encourage you to conduct your own research throughout your investing experience. What is the stock market? Well, the stock market is the central system where shares are bought and sold by an individual or an institutional investor. Nowadays, this is mainly electronic through major stock indices such as the FTSE 100. Well, what are stocks and shares? Stocks are effectively ownership certificates of a given organisation, while shares refer to a percentage of ownership of a stock in one particular company. For example, if a person who has bought 100,000 shares from a company with 1 million outstanding shares would have a 10% ownership stake in that company. What is the difference between trading and investing? Well, trading has the potential to make or lose money by speculating on securities over a short time frame. This is a high-risk strategy taking advantage of a volatile market. Whilst investing generally makes money by purchasing the asset and holding it over a longer time frame. This method is not as risky as day trading, as we focus more on the end result and not the knee-jerk reactions of a volatile market during the day. One very important factor when investing is your capital is at risk. In short, this means any money you put in, you have the potential to lose should it all go wrong. You can lose money when the price of the asset moves unfavourably or when a business invests in a project that is not successful. Publicly traded companies are required to disclose real and potential risk factors to investors. And this is why conducting your own research is imperative to stock trading. So how do you choose the right trading platform for you? Well, that's a very good question. With hundreds of different services and platforms available out there for you to access the stock market, choosing the right platform is critical for success in the stock trading game. Things you should look out for: low or zero commission rate. Day traders particularly need to be careful of the commission rate, as they are expected to be trading several times during that day. The higher commission rate, the more money they pay per trade. A good customer service rating is vital as well. Remember, you are trusting this platform with your investment. Now, this could be all of your available money. You need to be sure that you can contact their customer services, as well as withdraw your money without any arguments. Unfortunately, the stock trading game does provide a window of opportunity for some criminal activity. Please make sure that the platform you have chosen is legal, registered, and recognised for what it is able to do, so avoid falling into a scam. Items you can look for is recognition awards, such as the British Bank Awards. And you'll also want to be checking to ensure that the platform you are using is authorised and regulated by the Financial Conduct Authority. After experimenting with a few different platforms myself, my personal favourite is Freetrade. Freetrade is an app-based platform for your mobile phone. It's easy to sign up and it's commission free. They provide a variety of accounts for you to sign up for. I have subscribed to the Freetrade Plus account for $9.99 a month. It provides me with a great variety of shares to purchase, and the monthly charge is recovered through the profits of which I'm making on my investments. Choosing the right account. We've got as far as choosing the right platform for us, but inside that platform there are several accounts available for us depending on the type of investing we want to do. The first and primary one is the general investment account. This account is often free, unlimited maximum contributions, but there's often limited investment options available. The next option is the Stocks and Shares ISA. Often these are applied with a one-off or monthly subscription charge, and the limited amount you can invest per year is £20,000. However, this account often comes with a wider variety of businesses of which you can buy shares in. The self-invested personal plan. More often than not, annual charges will apply. You are limited to the amount you can earn. This was difficult when conducting the research as it varied from platform to platform. Some were saying it was a particular amount, others were saying it's as much as you earn. So I strongly recommend checking with the individual platform for their rules on this type of account. However, this does provide you various tax relief options depending on the type of account. The final account type that we will cover today is the Junior Investment Account. This account has been provided to invest on behalf of a child who can access the money later in life. There are charges per trade, i.e. commission. However, it does allow an opportunity to reduce the inheritance tax later in life. There are no investment limits, but you are strongly advised to check with your provider for more information as these varied from platform to platform. Choosing the right stocks. Ultimately, we're all in this game to make money. The first and key piece of information here is you must do your own research. Do not rely on the information given by somebody else. Would you trust them with that lump of money that you are putting in? Make sure what you are doing you fully understand and you are confident that you know what's going on with your money. Research the financial health of the company. Make sure their business plans are sustainable and they have a steady plan of action ahead. Consider the innovation levels within the company you're investing. Have they got any new products coming out, any new plans or developments that they're potentially releasing or expanding on? This is the area where you're going to be making money. If they are adding value to the company, your share price increases. This leads very nicely into price and valuation. Look at how much the company is currently worth. Analyze what they're offering, what they already have, and is the company currently undervalued? If the company is undervalued, when it gets reviewed, the company value goes up and the share price you got when the company was cheaper boosts with the company growth of what it's now considered to be worth. Finally, an item to look out for is dividends. This is a sum of money paid regularly, typically annually, by a company to its shareholders out of its profits. So not only are you increasing your investment through the growth of the company, but you're being rewarded for that as well. Finally, we'll cover the golden rules. Firstly, goals. Set realistic goals and expectations. Only invest cash that is not tied up. For example, do not invest cash that is a deposit for a house. Understand that your capital is at risk. Every penny of the money that you invest has the potential to decrease in value as well as increase, so only invest what you can afford to lose. Time. Make the time to keep up to date with the company you are invested in. Vox Markets has a fantastic app where you can subscribe to push notifications on the release of an RNS. An RNS is a legal requirement of a company to update its investors of the news and developments from within the company. This could be good news or bad news, and it is key to understand if you want to be a success in the trading game. Emotions. You cannot become personally attached to the company of which you're invested in. You are going to hear a lot of discussions going on in the company of which you're invested in. You need to be able to decipher fact from fiction. Investment forums contain rampers and de-rampers. Rampers like to overvalue the company to boost the share price higher, and de-rampers devalue the company to drop the share price. Their claims may have some factual content within them, however it's down to you to identify what that is and ensure that it's a valid claim. FOMO, or the fear of missing out, can be incredibly profitable or financially devastating. Bear in mind, if you're seeing a lot of action about a share price increasing that is already increasing, that share price increase has got to stop somewhere. In the share trade, news is very often old news as soon as it's released. Everything changes so quickly, and I've learned firsthand that buying in at the peak and only watching my money disappear is not a good idea. And that was caused because I had seen so many people posting on social media about the increase in a particular stock that had reached record highs, and I simply bought in too late. So be careful when you're seeing other people post about it. Another key factor is to diversify your portfolio. If you had all of your shares divided over 3 different oil and gas companies, if something was to happen to the oil and gas industry, you've lost all of your money. Try picking companies from different sectors to give yourself that back support. And ultimately, and I cannot stress this one enough, is do your own research. You will hear this time and time again, otherwise known as DYOR. It literally stands for do your own research. Everyone else will begin talking about products and companies and schemes ongoing, but until you validate those claims, that information is worthless, and it has the potential to lose you all of your original investment. I hope you've enjoyed this introduction to the stock market. Help us help you, and hit that subscribe button to follow us on YouTube and visit our blog for additional content at bullandbearinvestchannel.blogspot.com.